We got a couple big warning signs on the US economy, and they're coming from all directions. The gasoline market on Friday did something it hasn't done in 3 years, a rare signal that shows just how tough it's getting to be for US consumers. Now, obviously, gasoline prices are down, but so are oil prices. Even OPEC today acknowledged the global economy is in serious trouble. Yet, quite stupidly, the group pledges to keep making it worse, now promising to extend oil production cuts even further into the future, rather than letting oil prices tank with the economy. As I keep pointing out, oil is not inflationary. There's a short-term direct impact on the CPI, but when the economy is weak, a surge in energy costs will end up being disinflationary and more likely push it into recession. And if an economy is already experiencing a recession or maybe half a recession, an oil spike will just push it further into contraction. That's what continues to be corroborated and from all over the place. Income data on Friday, that was really concerning, but not unexpected. We'll go over that in this video. We got more stats that came out just this morning in the US that were incredibly weak and getting weaker. They say the economy is strong and resilient. Well, at least stock prices are at an all-time high, or some few big name stocks anyway. People can't make money in the economy, so why not go gamble at the NYSE casino? Maybe buy some GameStop shares. Those are up huge, even as the economy continues to fall apart. The disconnect between equities and the economy is maybe as large as it's ever been. So let's start with gasoline because that's a big one, and it's getting to be such a big issue that even the mainstream media is feeling that it now has to report on. We went from strong and resilient inflationary to what the hell's going on in gasoline. Well, here's Reuters. The U.S. gasoline market is flashing signs of weakness at the start of the summer driving season, a time it generally picks up strongly, and analysts say this clouds the picture for oil demand ahead of the OPEC Plus group meeting that kicks off this past weekend. And we'll go over OPEC in just a moment. Now, it's been weak. This is not anything new. Of course, I've been talking about this since last year. Gasoline demand has been incredibly weak, so they're just now figuring this out, or they're just now realizing how important this is. Back to Reuters. U.S. gasoline demand fell about 2% week over week to 9.15 million barrels a day, even as refiners ramped up to their highest run rate in 9 months, at least according to government data for the week ended May 24th. That's the EIA, or Energy Information Administration statistics. That led to a surprise jump in gasoline inventories, which pushed future prices for the fuel to a 3-month low on Thursday, and they've gotten even lower since. As of last check, RBOB, or wholesale gasoline, is down to $2.35 per gallon. But more importantly, for a brief moment on Friday, gasoline futures briefly flipped to contango. That's a situation where the futures price is above the current price or the spot price, which incentivizes the market to store more commodity, whatever it happens to be, in this case, gasoline. That's a signal that there's too much supply or not enough demand for a given amount of supply, which is a huge warning sign in gasoline because gasoline supplies and inventories had been thin for a very long time. So gasoline flipping into contango is a sign that the market is saying demand has really shifted here. Now even the mainstream media has to report on it. And we have to keep in mind, too, that U.S. gasoline usage accounts for about 10% of all global oil use. So this is a huge thing, not just in terms of the U.S. economy or the energy market. It feeds massively into the entire global energy picture, and therefore all sorts of implications across CPIs as well as economies and everything else downstream. Given what's taken place as far as U.S. drivers and their inability to drive as much as they had before, maybe because they can't afford gasoline, maybe because they're not working as much as they had been. But as gasoline use becomes weaker, that's a factor that goes into the oil price all over the rest of the world. So OPEC Plus met this past weekend, and what they said was, we're kind of surprised here at how weak demand is. They shouldn't be surprised, but using mainstream economic surveys and forecasts, they've come up with this consistently rosy idea that the economy is going to rebound any moment now. China's going to get itself going. The U.S. is strong and resilient according to everybody. So they continue to be surprised when all of those assumptions don't pan out. So here's the Nikkei describing the OPEC Plus meeting this weekend. The group agreed on Sunday to extend most of its deep oil output cuts well into 2025, exceeding expectations, as the group seeks to shore up the market amid tepid demand growth. Tepid is putting it kindly. Quote, we are waiting for interest rates to come down and a better trajectory when it comes to economic growth, not pockets of growth here and there. And that's the statement by Saudi Energy Minister Prince Abdulaziz bin Salman, our favorite Abdulaziz, who's surprised that the pain isn't going to be in the oil market, the pain is going to be in OPEC. Because remember, most OPEC members need 80, 90, maybe even higher oil prices just to meet their budget targets. So even though the rest of the global economy is sending so many signals saying, you guys really screwed up here. You pushed oil prices too high and too far, and it seems to have done some real damage across the global economy, including here in the United States. Undeterred, OPEC says we're going to continue with the production cuts anyway because we need high oil prices. Amrita Sen, co-founder of the Energy Aspects think tank, said, quote, the deal should allay market fears of OPEC Plus adding barrels back at a time when demand concerns are still rife. They're not concerns. It's in the data and statistics. What's catching up now is the global narrative of reflation and recovery and strong economies. The economy is asserting itself and had been hidden behind the geopolitics of the Middle East and the Russia-Ukraine conflict and everything else. Imagine what oil prices would be if it hadn't been for the production cuts and all of those geopolitical concerns and the premium. Oil would be heading a lot lower. And speaking of oil heading a lot lower, it actually is heading a lot lower today. As of last check, WTI futures were at 74.37, which was the lowest since February 7th. Now, even more important, while gasoline futures briefly flipped into contango on Friday, WTI futures are moving closer and closer to contango. In fact, as of this morning, last check, the 1-month calendar spread was just 15 cents. That's the narrowest since the middle of February, when we really started getting more geopolitical fears. The 3-month spread, which is really important, has dropped below $1, and as of last check was down to 68 cents. That spread hadn't been below $1 since middle of February, and that's the lowest, I think, since February 10th or 12th or somewhere around there. So the WTI futures curve continues to flatten out and move toward contango, even as OPEC is saying we're going to hold our production cuts even longer, especially from Saudi Arabia and Russia. Demand is asserting itself because demand, despite all of this stuff on the supply side, demand is incredibly weak. It's getting so much weaker. It is more important now to the oil market than everything else on supply and production and geopolitics. The reason why high oil prices are not inflationary in the intermediate and longer term is because in an economy that doesn't have an inflationary background, oil prices mean you have to rob from one part of the economy to pay higher energy costs. Because modern economies need energy, and so they are price inelastic. If the price goes up, you can't really cut back on the amount of energy that you use. You can cut back at the margins, which is what we're seeing in gasoline, but overall, most of the time, you got to pay the higher price. There's a high degree of, I'm going to use the word, stickiness as far as oil prices and demand is concerned. So oil prices go up, by and large, outside the margins, the economy has to pay the higher oil price, but it has to come at the expense of something else. And so as you're robbing one part of the economy to pay oil prices, what you're essentially doing is redistributing from the productive parts of the economy to one of the most unproductive parts of the economy. It's even worse than it appears. And so that's why you continue to see oil prices that go up in spike fashion. Those associate with recessionary periods. Because unless there's actual legitimate inflation going on, which there is not, then that means that we're having to redistribute in an unproductive, inefficient, and ultimately harmful fashion. And that's what everything continues to tell us. We have a weak economy. We don't have inflation. There was a short-run impact on the CPI, but longer run, more likely recession than not. And that's what all the data continues to show. And even the markets have been screaming about this all this time, except that for oil, it has been covered up by all of those supply stuff. What Saudi Arabia has been attempting to do, hold oil prices high, Well, that covered up the weakness, and in many ways, it has backfired big time. But rather than relent to reality, OPEC is saying we're going to double down on stupidity. Now, as far as OPEC is concerned, a big one is obviously China, and I've covered China a number of times. We know the Chinese story. It's not reflationary. It's not responding to stimulus, real estate problems, economic problems, global trade problems. China is a big mess, and it's not improving. So that knocks a huge support under the assumption that global demand is going to come back at some point. That's a big one. But we also have to keep in mind, as I said earlier, gasoline demand in the United States is roughly 10% of global output. So gasoline demand in the US that's incredibly weak only adds more demand trouble to the overall picture. But why is gasoline demand so weak? Well, prices went up too far, but they went up too far in relation to the underlying economic fundamentals of the US economy. And that means jobs and incomes. I keep saying this all the time. Income, income, income. And the income stats that the government put out on Friday for the month of April were not good. Not only were the April numbers weak, some of them were actually negative. Maybe just as important, the government admitted what I've been telling you for months. The economy changed last September and October. And the government just changed its income statistics going back to last September and October. So according to the BEA, the Bureau of Economic Analysis, these are the same people who put together GDP. Their version of income, and I'm going to use here real personal income excluding transfer receipts because that is a big one. That's one that even the NBER refers to when deciding to date a business cycle. So if they see a reduction or a prolonged slump in real personal income excluding transfer receipts, that's a key recession signal. So guess what? We see a very prolonged slump in this very statistic. It was up just 0.003%, basically flat in the month of April. It had been a minimal gain in March, and it had been negative in February. So you've got a 3-month contraction in a key economic and income account. And this weakness goes back to, as I keep saying, September and October. But in the latest revisions, the government revised this series going back to October and revising it down substantially. How much? As a result of these revisions, the March figure was reduced by almost 100 billion. That means that, first of all, that's an enormous revision, enormous downward revision, especially for anything that's not a benchmark change. And this is not a benchmark change. This is just their normal revision process. So not only is $100 billion a huge revision, it also goes back to September and October, and it makes the income statistics look more like the household survey. We're getting corroboration of the household survey view of income, jobs market, employment, therefore economic fundamentals. And the household survey said something changed in September and October to the point that companies have been reducing hours, maybe a few layoffs here and there, but taking proactive steps to manage their costs in a weakening, not strengthening, not resilient, in a weakening economic environment. That along comes Saudi Arabia and its stupidity, making things even worse and more painful. Some of the other numbers, real disposable personal income, that was down fractionally, down 0.06% month over month in April. Had been up minimally in March, but it was also down in February. So you got two negatives out of the last 3 months in real disposable personal income. As a result, personal consumption expenditures, consumer spending in the month of April was actually negative. And that's the second time in the 4 months of 2024. That was a shock to many people because they've expected consumers to hold up really well. Well, according to all of the corporate reports we continue to get, it's not. The consumers are tapped out, they're exhausted, they're weak, they're experiencing a weak labor market, and it's showing up in their spending behaviors. Because of all of the reductions in income and some other revisions, the savings rate came out to 3.6%, which matches the March number, which is another low one, which just shows consumers don't really have a whole lot of room here. Incomes are weak, so spending is weak, savings are minimal, and there's no rescue on the horizon. What are rate cuts going to do? And just to emphasize that everything that we're saying here today, the ISM Manufacturing came out and surprised I guess, analysts to the downside. Remember a couple months ago, it was the ISM Manufacturing that picked back up above 50 and had everyone talking about how hot and resilient and inflationary the economy was, because here was the manufacturing sector, according to the granddaddy of all PMIs, roaring back to life. Well, that's a distant memory too. It was only 1 month above 50 and now retreating for the second straight month. As of the latest figure for the month of May 2024, the ISM was down to 48.7. Expectations were that it was going to increase from last month's 49.2 to 49.6. So you've got another almost full point miss in the ISM. New orders fell sharply to 45.4, which is the lowest since last May. Demand is drying up there too. And one of the big things that people focus on with the ISM, the prices index had jumped to almost 61 as of last month. That one came down a little bit, just to 57, but at least in the right direction. The employment number moved back above 50 for the first time in a while, but at least according to the ISM, panelists are still reducing their headcounts in May through various ways, even if it's largely through attrition at this point. But you got the new orders index dropping into contraction. They also said the backlog orders regressed into even more contraction, really ugly level of contraction, as well as customers' inventories, which were at what they call the just right level, which means they don't really want any more future production either. So weak all around where it comes to the ISM. And the ISM Chicago Business Barometer, which came out last Friday, just to emphasize everything we're talking about here, ugly. That fell to 35.4. And it has been falling since last November, but 35.4 is the lowest of this entire cycle. And this one has gotten pretty low along the way. That's the lowest since May of 2020. Not good in manufacturing. Not good in incomes and the jobs market. Not good in demand for energy. It's not one thing, it's everything. So a critical signal on Friday, even if it was brief, the fact that it happened at all is one thing that you need to pay attention to. So that's the gasoline market, the futures market, briefly flipping into contango, sign of weak demand, which is corroborated everywhere. Now we're seeing the WTI futures curve move further and further toward contango. Not there yet, but that's another one that shouldn't even be a possibility, given the idea, the narrative of a strong economy, as well as production cuts. Remember, the OPEC has cut something like almost 5.75 million barrels per day, which is roughly 5% of global supply. It's an enormous amount. So how weak is demand that prices continue to fall and the WTI futures curve continues to flatten out and even threaten contango? Despite geopolitics and fears over that, oil prices are moving lower, gasoline prices are moving lower. We know about China. Incomes in the U.S. continue to show up weak, and now we've got proof that they're weaker than we thought, or at least weaker than most people thought. We thought they were going to be weaker. Then that's something big changed last fall. And it just keeps coming and coming and coming. We got Kohl's, Target, KFC, McDonald's, retailers, everyone saying U.S. economy, U.S. consumers are incredibly weak. May not have looked like the usual business cycle, but that's what the data keeps showing. That we have been in an unusual cycle this entire time. It was not inflation, it was not going to be disinflationary, and there is no such thing as a soft landing. I think the Kohl's report was one of the most striking ones that we've gotten so far. They stopped offering discounts and customers stopped showing up at their stores. I talked about that, the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.